Hey traders, Jonathan Rose, owner of Active Day Trader, and today we're going to talk about bonds because the Fed just came out with their decision on interest rates. I'm going to show you a very easy way to follow the overall equity market using interest rate products, using fixed income products. And we do that by following the yield curve. As the yield curve flattened, that was the big risk to the overall economy. In the past, when the yield curve has gone inverted, we've ended up in a recessionary environment. So as the yield curve flattened this time around, the market was getting nervous that we might end up with the yield curve inverted, so the short end having a higher yield than the back end. The flatter it would go, or the closer those yields got to be the same, the market's interpretation was a higher likelihood that we would have a recession, hence the stock market would fall. Well, today, 10-year futures, Fed announcement came out with some dovish rhetoric. 10-year future contract rallied. What I want you to look at is the yield curve. We can look at the yield curve in a variety of ways. The CME futures trade 2-year, 3-year, 5-year, 10-year, 30-year, and ultra bond. In front of you, I'm just doing the 5-year against the 30-year. What this really is, the 5-year is actually closer to a 4-year, and the ZB, the 30-year future contract, it's closer to an 18-year. So 18 minus 4, we have about 14 years of what's called duration, the difference between a 4-year note and an 18-year bond. And that's what this chart is showing. When it would go lower, it's flattening. When it goes higher, it's steepening. Lower, flattening, and you can see right after the announcement, very steep. Now, why does this matter? Here's why. Same chart, and I overlaid it with the S&P futures contract. The purple is going to be the S&P futures. The yellow is going to be the yield curve, the difference between those 4 years and 18 years, or 5-year future contracts times 4 minus ZB, the 30-year future contract. You can see that yellow again, remember? Flatter, steeper, flatter, steeper, flatter, steeper, and so forth. Well, look at the S&Ps as I overlap them. The same time the S&Ps were getting hit or going offered, notice the overall kind of trend of the yield curve, the yellow, flattening. So as the yield curve flattens, in this environment, the overall equity market was going lower. Yield curve steepened, flattened a little bit, steepened. Number comes out, or decision on interest rates come out, very steep, which naturally comes over to the equity market, and that's why the Dow's up 450 points. That's why the S&P's up a ton. The point is, simplify your trading by following the yield curve to help give you confirmation on the overall equity markets. As the yield curve, the difference in rates, steepens, gets further and further together in this environment, that's very bullish equities. If things turn and the yield curve flattens, and again, you can follow it by using this formula. You could follow it by going all the way to 2s and going all the way out to 30s. Couple of different ways that you can follow it. If you have any questions below this video, just leave a comment. I'll answer each one of your questions. But it's a really simplified tool in order to follow the overall equity market, because right now, equities are driven off interest rates. Don't they say don't fight the Fed? That's real, guys. Don't fight the Fed. Hope it helps. Any questions, leave a comment below. My name is Jonathan Rose, owner of Active Day Trader.